Welcome back to Kitco News. I'm Jeremy Szafron. Well, it's a big day in America. Donald Trump has been elected as the 47th president of the United States.
The American people for the extraordinary honor of being elected your 47th president and your 45th president.
Now, you heard it there. After first winning in 2016 as the 45th president, Trump is now only the second candidate in U.S. history to secure non-consecutive terms in the White House. The Republicans have also taken control of the U.S. Senate, flipping several Democrat-held seats, while of course holding on to their own. However, control of the House is still up in the air. Republicans are defending a slim majority, and it could take a week or more to get the final call. Meanwhile, Bitcoin soared to new all-time highs as the election results rolled in. The cryptocurrency jumped nearly 9%, trading above $75,000 U.S., surpassing its previous record back in March. Now, this rise ties into Trump's campaign promise to make the U.S. the crypto capital of the planet, with plans to establish what he calls, quote, a strategic Bitcoin reserve. Now, gold, on the other hand, is losing ground here, lost around $75, falling below $26.70 an ounce on the spot market. Treasury yields spiked while stocks rallied, with the Dow, the S&P, and the NASDAQ all hitting new all-time highs. The last time the Dow jumped more than 1,000 points in a single day was November of 2022. So what does this mean for the markets and, of course, the economy moving forward? Well, here to break it all down for us is Stephanie Pomboy. She's the founder of MacroMavens. It's an economic research firm specializing in emerging macro trends and their impact on global financial markets. Great to see you. Nice to have you back, Steph.
Wonderful to be back. I'm sorry, I'm a little haggard because, as you said, it was a very long night.
Yeah.
But exciting, and there's so much to talk about now.
Yeah, well, let's get into the election. I mean, as you mentioned, I'm on the West Coast. It was a very late night here. I want to jump into this because it was an interesting result. Of course, we saw it quite quick. But do you think that one of the underpriced or unpriced risks was that a presidential winner would be announced on election night? I mean, we did go into this election with headlines like it's going to be a toin toss, you know, the closest presidential race in modern history. Of course, those were the headlines dominating the mainstream media.
Yeah, no, absolutely. I mean, it's a relief to have the answer already. But, you know, this is the way the system is supposed to function. We've just gotten so used to the dysfunctional election system of the last several years. So it's a relief. I think the markets are obviously very happy to have a verdict. And as you said, you know, we're still waiting on a few races in the House and Senate to be called. But basically, they have a pretty good handle on what the policy is going to be going forward. And certainty is something that the markets really appreciate. So here we are.
Yeah, here we are. Well, we did see investors quickly pile into trades aligned with Trump's policies on areas like tariffs and taxes, government borrowing, obviously cryptocurrencies, like we said. What stands out to you in terms of the market reaction that we've seen today?
Well, it's really interesting, Jeremy, because in the whole lead up to the election, it seemed like if you overlay the S&P with the odds of Trump winning, you couldn't really distinguish the lines apart. The markets appeared to be discounting the Trump victory well in advance of election day. So you kind of went into it thinking, well, how much is left? You know, if he wins, it just validates the level to which asset prices have already climbed. But obviously, you know, we're doing spiking the ball in the end zone today. But the thing that really stands out to me is in the brief overview you gave the viewers of where the markets stand, you have the stock market up 1,200 points in the face of soaring bond yields. That's an untenable relationship. You know, that can't persist indefinitely. We've already seen the stock market move higher in the face of this backup in rates since the Fed ostensibly eased. You know, they cut rates 50 basis points and everything did a U-turn, and, you know, everything from the treasury market to the corporate market to mortgage rates and everything actually went higher rather than lower as the Fed had intended. And yet the stock market has kind of ignored that. That just cannot persist for an economy and a corporate sector in particular that's massively levered. So higher for longer, even though the Fed's cutting rates, higher for longer is probably going to be the story for the interest rate side of the markets. And that will become a headwind for equities, the question is, will the earnings side, given the Trump victory, be sufficient to overcome the headwinds of interest rates? And so we'll have to see. For that, we'll really be drilling down on who controls the House and the Senate and how much of a majority and whether a lot of these policies can get passed and what they'll look like when they get passed. So it's going to be a little, we'll have to do some fine tuning, I think, over the next few weeks.
Yeah, absolutely. A lot to watch for, of course. Okay, well, I have to talk to you before getting into the stock market and the Fed. I mean, we have a big week still ahead of us, but let's first talk about gold. I mean, why is it falling so much? As I said, gold fell around $75 on Wednesday morning. We're seeing it still take a little bit of profit taking, a little bit of risk, here. What's going on here, Steph?
Well, I think this is very simply the opposite of the move in the dollar. People are looking at the dollar index. It's soaring today, and their analysis is just that simple. Dollar up, gold down. They're viewed as an inverse of each other. So I happen to believe this is sort of a very temporary blip in what will continue to be a massive bull market for gold. And that has to do with my view that, this move in the dollar, again, is temporary, but not sustainable because we have two options. We either keep rates really high or we have the dollar go lower. Those are the two valves for our financing issues, where we're issuing $2 trillion of paper and foreign central banks are buying essentially zero now. Something's got to give. Either you're going to have rates go up to a level that attracts those buyers or the dollar go down. And obviously for policymakers, having the dollar go down, which is sort of stealth in the background, is by far the preferred means to accomplish that. So I think this move in the DXY is temporary, and we'll see that move lower and gold will turn back up.
Okay, so we're going to see a little bit of a long bullish case for gold again. As you mentioned, we did see the U.S. dollar index, which measures the U.S. dollar against a basket of, 6 other currencies. It rose around 2%, 1.8. During the campaign, Trump acknowledged that the dollar is losing reserve currency status and that it's a huge problem. I mean, he's one of the few politicians to address this and to vocalize it. He's saying that it's equivalent of losing a war and that we need to push back against the accelerating global de-dollarization trend. I mean, Trump vowed to impose 100% tariff on goods from any country that abandons the dollar in trade with the U.S. Back in March, I think he told CNBC that he would just not allow countries to go off the dollar because losing that standard would be like losing a revolutionary war. He added that too many countries are now fighting to get off the dollar and we can't let it happen. We're clearly seeing countries selling U.S. treasuries, including, as we mentioned, China, Japan. We're seeing a lot more trade done via local currencies, bypassing that U.S. dollar, including oil, Steph. So how do you see the dollar performing under the Trump administration?
Well, I think this is such a huge issue, and I would argue that the future of the dollar as a reserve currency is our national security issue. Our deficits are out of control, and if we don't take measures to shore up the global confidence in the dollar, we're going to have a massive problem on our hands in terms of financing those deficits and potentially having a real hyperinflation problem here. So actually, I did propose to the Trump administration, I haven't had any real reaction, no bites yet to this, that they consider making the interest on treasuries tax-free as a way to create a domestic source of buying for our paper rather than relying on foreign central banks. And that would help reduce our borrowing costs and shore up our financing at home rather, again, than relying on the kindness of strangers. But putting a pin in that, I mean, I think as you articulated, Jeremy, we've seen this move by all around the globe and really spearheaded by China, Russia, and the other BRICS countries who just had their meeting last month, where they're, continue to make real progress in moving away from the dollar. And as you mentioned, the linchpin for that is really what comes down, what happens to the petrodollar standard, and do they continue to transact oil in dollars or other currencies? And we have seen a lot of shifts at the margin to trading oil in other currencies. But as long as Saudi and OPEC maintain that dollar reserve standard, in theory, we should be okay. But I think it'll be interesting to see what the Trump administration does to really shore up that global confidence in the dollar. But it's a key issue. And this is one of the reasons why I've been bullish on gold so long, is that we have seen this global exodus. We do have this existential problem of how we're going to finance our deficits in this demand vacuum that they're leaving behind. And no one has really proposed any clever solutions. And in the absence of any solutions, the dollar goes lower and gold goes higher. So I'm waiting to see what they propose here.
Okay, well, let's get back to gold on that topic for a second, because prior to the sell-off on Wednesday, gold was on course to see its best gains in 45 years, Steph. I mean, it's up more than 30% year to date. So what's your outlook into, the year end next year? Can you share a price forecast? I mean, you seem very bullish on gold.
Yeah, I mean, again, I'm less bullish on gold than I would have been had the election outcome gone the other way. That would have been wildly bullish for gold. And I will say this morning, I'm very happy to be taking the hit on gold for the outcome that we got. I think that's obviously more important for the future of our country. I'll take the hit to the pocketbook for a little while for now. But, the issue is, how are we going to finance these deficits? And that is really what's been driving gold all year. As you've seen, the deficit math has gotten so bad to the point that we're now, pressing the $1 trillion on interest payments alone. And I think that sort of started to come into the mainstream discussion for investors and the financial media. And that's really helped to drive gold. But I would also underscore that the demand that we've seen for gold has been almost overwhelmingly to this point from Eastern buyers. It hasn't been here in the West. It hasn't been retail investors so much. It's really been those BRICS countries and people in Asia, et cetera, who are seeing what's happening and, here in the US with their deficits and taking action. Which means there's a lot of room, in theory, left for the Western investors to get involved here, should they begin to, rub their eyes and wake up to the reality. So I do think there's more room to go. I just keep coming back to who is going to finance these deficits. It's math. We're issuing $2 trillion in paper a year, and foreign central banks, per the latest Treasury capital flows, took down $4 billion. That's not a mistake, $4 billion with a B over the last 12 months. So they're effectively buying zero. What we're relying on now in terms of deficit financing is private institutions. And I think mostly right now it's hedge funds doing this treasury basis trade, which is a little esoteric and frankly a little terrifying because it sounds eerily reminiscent of LTCM, what's going on there. But that just, it's not a sustainable or a reliable source of financing over the long haul. So this is an issue that the markets are going to have to grapple with. And every day that we see Treasury yields move higher brings that issue forward into the reality. So.
Yeah, we'll get into the debt impact because, it's going to be huge. But what about the geopolitical driver for gold? Trump said that in the past that he could broker a deal between Ukraine and Russia in one day if elected. In his victory speech, he said that he'll vow to, quote, stop war. So do you see some geopolitical hotspots calming down in the next year?
Well, I would certainly think so. If history is a guide, there were no wars and there was peace pretty much all over the world during his first term. So I would anticipate that we'll see things calm down. However, I do struggle with this one because it doesn't appear that there was a geopolitical risk premium associated with Ukraine or the Middle East in gold. It was really more this shift, the de-dollarization shift, and the weaponization. I would say it wasn't the war in Ukraine, it was the weaponization of Russia's reserves that really precipitated the move in gold. Because if there were some kind of geopolitical premium in there, you'd think you'd see the same in treasuries, and you clearly haven't seen that. Yeah. So that's that safe haven, that rush to safe havens hasn't been evident in treasuries. And so maybe that's something that isn't reflected in the gold price, which, again, would just underscore how deep the real demand is from real money buyers in those BRICS countries and the Far East, as they look to hedge what they see as the inevitable debasement of the dollar.
Do you see? What's a price target there, Steph? I mean, we're watching what's happening with BRICS, obviously the geopolitical situation. We had a lot of analysts talking about $3,000 gold. This does change some things. I mean, are you comfortable giving, where you think this might go?
Well, I thought 3,000 was a layup. We should go through that like a knife through butter. Now, I think there'll be some broad reassessment because obviously the outcome of this election changes the economic backdrop. The number one cure for deficits is growth. So if we can get this economy really growing, and I happen to be, as you and I talked about on the last conversation, a pretty healthy skeptic about the veracity of the government statistics that are coming out. When you look at the gap between the statistics as reported and what consumers say they're feeling on the street, when 3 out of 5 Americans tell you we're in recession now and we have been since March of last year, clearly there's a mismatch between what the government's reporting and what people are actually experiencing. So if we have a new policy that helps support growth and CapEx picks up and employment really gets to a point where people don't have to work 2 and 3 jobs to make ends meet, that's a game changer and could help really at least restrain the growth in this deficit, which is, kind of now in this doom loop where higher rates are feeding the interest expense. But we'll have to see, how quickly can these policies get implemented, what happens again with the House and Senate, and how do these bills look when they finally get through, how much of what Trump has proposed actually comes to fruition. But it's certainly the better outcome than the alternative. And, I do think that it's less favorable for gold, but that doesn't mean it's unfavorable for gold. I think it just means, we still have to deal with this massive financing issue, but there's a chance we might get some solutions that will begin to chip away around the edges. But this is a big, big problem. And it's not something that, Trump on day one can solve and, restore the confidence in the dollar. This is going to be a big project and will take a lot of work and a lot of time. So
but as you said, markets excited. I mean, Bitcoin was also a huge trade going into Wednesday as it hit a new record high above $75,000. Year to date, I think Bitcoin's up more than 75%. So let's dive into this a little bit more. At the Bitcoin 2024 conference in Nashville over the summer, former President Donald Trump, or I guess we could call him President-elect Donald Trump, pledged to make Bitcoin a strategic reserve asset. I mean, he's promising to keep all Bitcoin currently held by the U.S. The U.S. as a country currently leads in Bitcoin holdings, having seized massive amounts with illicit actors, with the estimate suggesting that the government holds more than 200,000 Bitcoin, maybe at today's price worth about $15 billion. Trump's pledge came as Senator Cynthia Lummis proposed the Bitcoin Act. It's a bill that offers the creation of a strategic Bitcoin reserve for the U.S., making it the first nation to use it as a savings technology. What's your outlook here into Bitcoin going into next year and this year end?
Well, it probably won't shock you, given my advanced age, that I'm a little bit of a Luddite. So I generally, I like things I can touch and feel and understand. Bitcoin, obviously, I understand the excitement about it, and the people who are bullish on it really are bullish on it for all the same reasons that us who are invested in gold are bullish on gold. I just don't see that they're substitutes for one another. But, I think Trump was very clever to embrace crypto. And, there's no harm in creating this, crypto reserve, as far as I can tell. I happen to think it's a speculative asset. It has improved itself as being a substitute for gold and really a safe haven with all the hard asset qualities that gold and other precious metals have. But again, what's the downside? And, if it helps sweep him over the finish line, then, good on him. But frankly, it's just not an area where I feel like my opinion is really helpful, because I have been largely sort of standing back saying I just don't see the long-term outlook for crypto as replacing the dollar or gold. One of the things I've said about it is, for example, Bitcoin, its success ensures its failure is sort of the line I use. And by that, I mean, if it really gets to a point where it starts to compete with the dollar, the regulatory boot is going to come crashing down on it so hard and so fast, because no government is going to abide the control of money being shifted away from itself. They will want to control money. So if Bitcoin actually gets to a point where it rivals the dollar, they will encircle that and make sure that they bring it into the fold. Yeah, in that regard, I think, it's fun to speculate between here and when it gets to that point, and there's probably a ton of money to be made in that process.
Right.
I'm just not clever enough to figure out, exactly the timing of when the ride ends. So.
Yeah, fair enough. I mean, the markets are smart. And Steph, this all comes as the United States national debt is about to surpass $36 trillion. I mean, the Congressional Budget Office projects that by the end of 2027, the debt held by the public will exceed 106% of the GDP, breaking a record set in 1946 during the post-World War II era. Given this outlook, what's your own market position right now?
Yeah, I mean, this debt and deficit thing, as I said, I think it is the existential threat to our economy and the dollar hegemony. And so my position has been, I'm not invested in the stock market. I am in hard assets because I fear that the only real solution here, the palatable solution, is to eventually inflate away our debts at this level. There really is no other option. So that has been my position. And I think what's interesting is that until today, if you look at the market action so far this year and over the last 12 months, going back into last year, what we've seen in terms of equity gains has been an inflation illusion. The S&P has trailed gold. So gold is, the S&P is actually down in real terms, but everyone looks at it, every day without considering the silent inflation that's going on in the background, and they think they're doing great, but they're really being debased, and that's why gold is massively outperformed. So it's a little bit of an abstract notion, but I think people really need to wake up, just like the man on the street realizes that the price he's paying more for the same amount of stuff than he was. It's the same with the S&P. You're still buying one share, but you're paying a lot more. And meanwhile, gold is telling you that you're losing the purchasing power of your dollar every day. So I think it's important for people to focus. People are very dismissive of gold, but looking at the market performance relative to that yardstick is crucial, I think, just to keep perspective on real versus nominal gains.
So talk to me about these hard assets. I mean, are you just long in gold then?
Yeah, I'm long gold and a little bit of real estate, and I do have a little bit of exposure to EM because you have a lot of resource producing economies in the emerging market, so it's basically a kind of a levered bet on the commodity space. So those would be my positions, but I feel like I can sit there, and I actually have been being paid to sit there and doing very well in those positions while I wait and see how things flesh out. Because right now there's, I know we now have a little certainty about the election, but there's still plenty of uncertainty out there in terms of what happens with the BRICS and how we are able to shore up confidence in the dollar and what happens with this impact of this kind of doom loop that's set up here with higher interest rates mushrooming out our deficits. And obviously days like today aren't helpful because while markets are discounting more growth, they're pushing rates up. which is just mushrooming that deficit farther and bringing forward the day when we're, the day of reckoning, essentially.
The day of reckoning. Speaking of which, another development we saw was Trump saying that he would invite Tesla and SpaceX CEO Elon Musk into his administration to eliminate government waste, the Musk effect. Obviously, Musk has referred to the potential effort as the Department of Government Efficiency, or DOGE, the name of a meme and cryptocurrency that he's popularized. How do you see this playing out?
I love this. I mean, I think it's just brilliant. And what Washington needs is some real entrepreneurial spirits, businessmen who come in there. They're not all about pork. They're going to come in there and it's clean house. And I loved Elon Musk posted something this morning, the picture from when he took over Twitter, and he had this sink, and he's now going to the White House with the sink. And I thought, well, this is just brilliant. This is what Washington needs, is to get all the waste flushed out. I mean, I think we'll probably all be blown away at how much fat he's able to cut without anyone noticing anything missing in their lives whatsoever. And cutting bureaucracy will be a massive plus for the economy. I think that's probably the biggest boon out of anything. Maintaining the tax cuts or extending the tax cuts that were due to expire will be important. But I think the deregulation is really going to be crucial. So that's a huge one. And obviously, cutting the fat in Washington, I mean, 4 years may not be enough time for Elon Musk to cut all the fat that's up there.
Yeah. Steph, you talk about that day of reckoning. We're waiting for it, especially with all this debt that no one seems to be talking about. When's it coming?
Well, what's really interesting, Jeremy, is with regard to the federal government, they can buy themselves time. They have the power of taxation and a printing press. But these higher rates that are feeding the doom loop in the deficit are also impacting the private sector. We have obviously got corporations that are massively, record leveraged, and they had been rolling paper short term in anticipation of this Fed rate cut. All of last year, the junk yields and spreads came down in anticipation that when the Fed did the pivot, rates would come down. And so everyone basically was like, look, if borrowing costs for our company that we're lending to are going to come down a year from now, we may as well throw them a lifeline now just to keep them, there's no reason to wait because it's going to happen eventually. And now that we're seeing rates go back up, I think that calculus shifts. And so you're going to have a problem for a lot of the lower echelon of corporate America that already can't service its debts. And that unfortunately describes a much bigger swath of corporate America than most people imagine, because they focus narrowly on the S&P 500 or even more narrowly on the top 7. But when you realize that like 40% of small cap companies are unprofitable, clearly they're not servicing their debts. 17% of mid caps are unprofitable, and 7% of the S&P, which is a pretty high number for the top 500 companies in the country. So I think that's going to be a major issue. And then we haven't even talked about the banks. But, the banks have been sitting on $500 billion on unrealized losses on their treasury and agency, on their safe securities. That's not going anywhere. It hasn't been cured. The whole idea was, well, that's just temporary. And the moment the Fed pivots, all those losses will be cured and their balance sheets will be made whole again. That's clearly not happening. And in fact, maybe getting worse. So those issues, I think, are the ones that are really going to come to the fore first. The deficit probably has a longer fuse. I think the fuse for the deficit is expressed through the dollar. And so we'll have to watch gold for that. But I think these private sector and banking issues might actually precipitate the Fed going back to QE sooner. Right now, no one thinks they're going back to QE at all. I happen to be one of the fringe people who thinks it's just a matter of time before they start re-expanding their balance sheet to try to contain the slow motion train wreck in the treasury market.
Right. Well, you talk about, they can turn that tap on, keep printing money, but what kind of a crash are we looking at if this comes down? I mean, is it going to be like a 2008? We're going to see banks? Where's the implosion?
Yeah, well, I think the real source of concern right now is in the shadow banking system, because obviously that's opaque and we don't know what's going on there. And the really scary part is obviously this boom in private credit, which went from nothing to 1.5 trillion almost in the blink of an eye. And you read every day about the Fed and other financial regulators trying to get their arms around what is going on there, and how they're pricing these assets and valuing these assets. So I think that it would seem to be an obvious area where problems might begin to bubble up, as people are marking assets at levels that are just have no bearing in reality. And
Right.
when their investors come in and say, "Hey, we want our money back," and they actually have to mark in a real market, we could have major problems there. So we'll see. But the banks, the conventional banking system isn't in great shape either. They've got the commercial real estate losses continue to mount. And again, they've got this massive book of underwater treasuries and agencies. So, we'll see how all that plays out. But I would anticipate that the Fed will act in anticipation by re-expanding the balance sheet. They'll come up with some new, they won't call it QE because that's been tarnished now. So they'll come up with some new name for this facility that they will employ to help push a little more liquidity into the financial sector.
Let's, like Friends says, let's pivot here. Let's talk a little bit about, obviously, on top of these election results, investors have the Federal Reserve, the FOMC meeting tomorrow. Markets pricing in nearly 100% chance of a 25 basis point rate cut. This would follow a 50 basis point cut that we saw back in September. After this, we'll have another meeting in December to wrap up the year. You talked about quantitative easing. What's your thoughts here?
Yeah, I mean, I think that there has been too much focus on the Fed funds rate and not enough focus on the balance sheet, has been my view. And one of the reasons I say that is that the inflation data that the Fed purports to use as its sort of target are moving in the wrong direction, and they have been for a while. So the case for them to be cutting rates was slender to begin with, and it's just getting thinner by the day. So it's not like they have a tremendous amount of runway to be cutting rates in the face of that. And now with the Trump election victory and expectations that the economy is now going to get a boost, that case gets, probably just evaporated. Right. So this 25 basis point cut tomorrow, it's priced into the market. So I guess they'll do it since they figure there's no cost to it. But I think all of these will be proven to be a mistake, given that the inflation data will probably start to perk up again. So that, again, is why I focus on the balance sheet, because I think the Fed's hands will be tied in terms of cutting rates in the face of strengthening growth and hotter inflation. And the only way they'll be able to provide relief to the financial system and the corporate market will be through a re-expansion of the balance sheet, which also will help resolve our issues with the deficit financing, which, of course, they made worse by issuing T-bills to finance $2 trillion deficits, which was just, should be considered felonious behavior, but I'm not in charge. So.
Not in charge yet, Steph. Okay, well, let's get to your own macro outlook right now. I mean, especially given this latest downbeat job numbers out of the United States. I mean, how stark is the difference between these official numbers and this data we keep seeing versus what's really happening on the ground? I mean, are we already in a recession?
Yeah, I mean, the employment data has probably been the worst in terms of the inaccuracies there and the false impression they're giving of strength. And you don't really even have to drill that far beneath the surface of those monthly headline numbers to see how bad things are, because you've had this yawning gap between the payroll survey and the household survey for a long time, and it's just gotten wider and wider. And the thing with the household survey, the payroll survey, if you have to work 2 or 3 jobs, it looks like everything's great, that you're adding 2 to 3 jobs to the headline job numbers. But when you call up a household and you ask them, are you employed? There's only one answer. Yes, I'm employed. So that's why you've had this situation where people get all swept up with excitement about how strong the payroll numbers are. But what they miss is that multiple job holders have hit, record highs. We actually have a decline of over 1 million jobs in terms of full-time employment, and a huge increase in part-time employment. And I think what's happened there is obviously, as the economy has started to slow, companies who were chastened by how difficult it was to get people back to work after COVID are reluctant to let people go. It took them so long to hire people back that they don't want to chop heads immediately. So what they've done is they've cut hours, and they've cut everyone down to part-time hours. So those people then have to go out and take out a second job to make the same amount of income and support their families. And so I think that's the silent story that's been going on for the better part of a year and a half, behind the curtain, while everyone has been, celebrating these strong payroll numbers. And that's why the consumer confidence numbers have been abysmal, and their assessment of the job market has been, absolutely horrible. And their assessment about the likelihood that their income outpaces inflation has been the worst in history. So clearly, that employment picture that we're seeing every month has been really misleading. But again, things have changed now. We have a new president, or a new administration with policies that will be radically different from the policies that we've seen over the last 4 years. And hopefully, if we go back, I have to remind myself that in 2016, when Trump first won, we were kind of in the midst of a massive corporate credit crisis. We had a huge increase in corporate bankruptcies because of backup in interest rates. The economy was clearly slowing, and yours truly here was forecasting that we're heading into a recession. And then Trump won, and he immediately implemented his tax cuts and slashed regulation. I mean, he was cutting regulation like crazy. And the economy did an absolute U-turn, and the corporate credit market calmed down and, enjoyed a new up leg. So, I'm mindful that can happen again. Expectations can create the reality, especially since the markets have seen this show before. They saw it 4 years ago, so they know what to expect. So I'm kind of in a situation now where I'm just kind of standing back and watching to see how things play out. I'm hopeful that the economy can really recover, and we can get people to a place where their real incomes are growing and they're able to save and pay down their credit card debt and really take breathe a sigh of relief. But I am concerned about this push-pull between stronger economic expectations and interest rates. And we're seeing that already today in terms of the backup in interest rates across, the credit markets. That's a major headwind for an economy as levered as ours. So we really have to always keep that in mind.
Fascinating time, Steph. Fascinating time, as always. Well, listen, thanks for coming on today. Stephanie Pomboy with MacroMavens joining us. And not your dog today, but we hope to say hi to him as well.
Well,
thanks,
there's always next time. Thank you so much.
I appreciate it. We'll have you on too. I mean, it's an interesting macro environment. So in the next couple of months, once things settle and the dust settles, we'll have you on for an update. Looking forward to it.
Me as well. Thank you.
Thanks, Steph. Appreciate it. I'm Jeremy Szafron. For all of us here at Kitco News, thank you for watching. We've got great content coming your way this week. So hit the subscribe and notification button. We'll see you next time.